The 20-year liquidity sink. The United States Treasury is legally required to remove 5% of the total Bitcoin supply from the global market for 2 decades. With the official introduction of the ARMA Act yesterday, the transition from a speculative asset to a codified sovereign reserve is no longer a theory. It is a federal mandate. 1 million Bitcoin are being moved into a legislative vault that no president can touch without a supermajority in Congress. This is the first time in history a superpower has intentionally created a massive liquidity sink in a digital asset class. And the disruption to the global bond market is only the first move in this sequence. The metabolic consequences for traditional finance are about to get much stranger. The legislative supply floor. The ARMA Act does not just mandate holding, it effectively deletes these coins from the circulating supply. Unlike gold reserves, which the Treasury can lease or swap behind the scenes, these digital assets are bound by a 20-year lockup that treats them as permanent collateral. For the institutional investor, this creates a synthetic supply floor that cannot be broken by a change in political administration. You are no longer trading against retail sentiment or exchange liquidations. You are competing with a nation-state that has legally barred itself from selling for a generation. This turns the federal government into the most significant non-seller in history. This fixed posture triggers a specific type of sovereign game theory, the sovereign front-running effect. When the largest economy on the planet commits to a 20-year accumulation plan, the rest of the G7 moves from skepticism to survival. We are already seeing the first ripple effects as central banks in Asia and Europe begin adjusting their reserve ratios to account for the American position. The ARMA Act forces a sovereign front-running effect where every other nation must decide if they can afford to let the United States dominate the only finite digital territory left. If they do not start their own programs now, they will be forced to buy the remaining supply at prices the US has already pushed into the stratosphere. This is a hostile takeover of the world's most scarce collateral, and it finally addresses the ghost of the original creator, mirroring the Satoshi stack. For 15 years, the 1 million Bitcoin in the original wallets of Satoshi Nakamoto represented the ultimate tail risk for the market. The ARMA Act essentially creates a second Satoshi. By targeting a 1 million coin stack and locking it behind a 20-year federal wall, the government has neutralized the original founder's supply shock. We are entering an era where 10% of the total supply is permanently dormant, split between a pseudonymous ghost and the American Treasury. This doubles the effective scarcity of the asset. The market is now being forced to price Bitcoin based on a 19 million coin reality, effectively erasing 2 million coins from the sell-side equation forever. This realization changes the very nature of national debt. The Cryptoreserve Hierarchy. The ARMA Act marks the definitive end of the petrodollar era and the birth of a new crypto-reserve hierarchy. By combining a 20-year legislative lockup and the strategic neutralizing of the Satoshi supply, the United States is re-engineering how global collateral is measured and held. For the strategist, the implication is clear. The volatility that once defined Bitcoin has been repurposed as a tool to devalue competing fiat currencies, while the American reserve remains shielded. This is a transition from using debt as a tool to using absolute scarcity as an anchor for national power. What changes now is the relationship between digital assets and sovereign interest rates. The old financial system is being forced into a legislative trap that cannot be exited without adopting the very asset it tried to ignore. Watch the yield on the 10-year Treasury next month. If it continues to decouple from Bitcoin performance while the ARMA Act moves toward its final vote, the new global standard has officially arrived. Subscribe for more.